and welcome to our sixth and final module in our Bookkeeping Basics course, Recording Transactions in General Journal and Relating to Entries in QuickBooks Part 2. I am Kathy Grosskirth, and I am your facilitator for this module and for the course. Again, welcome and congratulations for making it to the final module of our Bookkeeping Basics course. Here is an overview of today's lesson. In our previous lesson, we worked strictly with the balance sheet accounts, which are assets, liabilities, and owner's equity, to journalize transactions. In this lesson, we add income statement accounts, which are the revenues and expenses, to the mix to journalize transactions, while we continue to relate these transactions to QuickBooks entries. Before we move on to Transaction 1, in Part 2, make sure you have your sample form handy, as well as the blank general journal form and your handout, so that way you can go through each of the steps before we actually record the transactions. Ready? Let's get started. Let's jump right into our first transaction, recording income received for services rendered. As you may recall from our T account exercises, in December, we opened our doors to our first customers. On December 15th, 20XX, Sarah Jennings recorded $5,000 in cash and checks received from various clients for her bookkeeping services. We will use our sample form and blank general journal form to journalize these transactions. And on the next slide, we go through the first 3 steps that we need to go through in journalizing this transaction. Here we discuss the first 3 steps for Transaction 1, recording cash income from services rendered. Be sure to have your handout handy, as well as your T account handouts if you need them. Step 1. What are the accounts affected? The accounts affected are cash and service income. Step 2. What are the account types and do they increase or decrease? Cash is an asset type. It increases by $5,000. Service income is a revenue type. It also increases by $5,000. Step 3. Which account is debited, which account is credited, and how much for each? Cash will be debited for $5,000. Service income will be credited for $5,000. On the next slide, we actually go through and talk about the journalizing of Transaction 1. And now we discuss Step 4, journalizing Transaction 1. But before we actually get into the discussion, make sure you have your sample form handy. You should have room on your sample form to record this transaction and the next one. So make sure you skip a line before you start recording the transaction. You must leave a blank line between each transaction. Start with putting the date in the date column. Then you're going to enter cash flush with the left margin in the description column on that same line. Enter $5,000 in the debit column, including the 0 cents and leaving out the comma and the dollar sign. Right below that, in the next line, you're going to enter service income, indented 1/2 inch from the left margin in the description column. Enter $5,000 in the credit column, including the 0 cents and leaving out the comma and the dollar sign. Finally, after that line, you're going to enter a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. Before you move on any further, be sure to double check your work and check all the handouts and make sure you understand what you're doing before you proceed any further. Once you've done that, we're going to go into relating Transaction 1 to a QuickBooks entry. And now let's relate Transaction 1 to a QuickBooks entry. For the purpose of this example, the assumption is that the individual customer accounts are kept current in a separate database for solid internal controls, checks, and balances. So, all that is needed here is to enter the aggregate totals at the end of the week or month, depending on the company's policy, which we have done here in this diagram. we will discuss what you see here so you'll understand what we did. In the top left corner, you'll see where it says Deposit To, and you'll see the drop down where we have chosen Cash, which is our bank account. It's also on our asset account listing. We also have the date listed as 12/15/2013. Remember, there are no XX dates in QuickBooks. In the memo field, we type total customer receipts for December 20XX, and we copy that same information down in the memo field on the line item, which we'll discuss right now. Under the Receive From column, we leave that blank. Again, we are doing aggregate totals. The From account is our service income revenue account. No check number, no payment method needs to be listed. Again, these are aggregate totals. We enter the $5,000 under the amount area. Once we save and close this transaction, we can now run the income statement report in QuickBooks, which will show our revenues of $5,000 equal our net income thus far for December 20XX, which we will do on the next slide. We continue to relate transaction 1 in our general journal to our QuickBooks entry. Up to this point, we have not been able to run an income statement because we haven't had any revenues or expenses. But now that we do have an income statement item on our books, we can run the income statement report in QuickBooks, which we have done here. You can see where the $5,000 in revenues equal our $5,000 in net income thus far. Since the $5,000 in cash and checks are the only income recorded thus far, and since we have no other expenses recorded at this time, our net income totals $5,000. Hopefully this makes sense to you. Now let's move on to transaction 2. And now we're ready for transaction 2, recording credit income from services rendered. As you may recall from your T account exercises, on December 18, 20XX, our business earned $1,500 of service revenue from various clients who were extended credit. This is monies owed to our business. When using the accrual system of bookkeeping, it is required to recognize earnings at the time they occurred. More about this a little bit later. In the meantime, we have created an asset account called Accounts Receivable to track these earnings. And in the next slide, we discuss the first 3 steps involved in journalizing this transaction. Here we discuss the first 3 steps to journalizing transaction 2, recording credit income from services rendered. Also be sure to refer to your handout as we go through these steps. Step 1. What are the accounts affected? The accounts affected are accounts receivable and service income. Step 2. What are the account types and do they increase or decrease? Accounts receivable is an asset type. It increases by $1,500. Service income is a revenue type. It increases by $1,500 as well. Step 3. Which account is debited, which account is credited, and how much for each? Accounts receivable will be debited for $1,500. Service income will be credited for $1,500. On the next slide, we actually go into journalizing this transaction. And now we're ready for step 4, journalizing transaction 2. Using your sample form, skip a line between the previous transaction and the one you're getting ready to record. You're going to enter the date first, and then you're going to enter accounts receivable, flush with the left margin in the description column, entering $1,500 in the debit column, including the 0 cents and leaving out the comma and the dollar sign. Next, you're going to enter service income on the line directly underneath that one, indented 1/2 inch from the left margin in the description column. Enter $1,500 in the credit column, entering the 0 cents and leaving out the comma and the dollar sign. And underneath that line, you're going to enter a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. On the next slide, we'll talk about relating Transaction 2 to a QuickBooks entry. And now we relate Transaction 2 to a QuickBooks entry. To simplify our QuickBooks example, we've created one customer in the sample file named Sweetwater Mission. This customer was invoiced in the amount of $1,500, which is shown below. In reality, a business would have several customers listed and separate invoices would be created for each. Now, I won't go into the details of this diagram. Hopefully, by now, you should be able to figure out what's going on. Once we save and close this transaction, we can run our income statement, which is also known as a profit and loss, and our balance sheet. We start with running our income statement or profit and loss on the next slide. As we continue our discussion of relating Transaction 2 to QuickBooks, we have run a profit and loss statement including all of the transactions entered into our QuickBooks file to date. Remember that profit and loss is another name for income statement. QuickBooks uses profit and loss as their standard terminology for income statement. This terminology can be updated in the QuickBooks program at any time. What's important to remember here is that our service income has increased from $5,000 to $6,500. Since we have no expenses to subtract from our income at this point in time, our net income equals our total income of $6,500. On the next slide, we run two versions of our balance sheet, one under the accrual method of accounting and the other one under the cash method of accounting. And we will talk about both of those on the next slide. Wrapping up our discussion of relating Transaction 2 to QuickBooks, we show you two versions of the balance sheet that we have run in our QuickBooks file. As you may recall, in earlier lessons, we talk about the accrual version of accounting versus the cash basis of accounting. In accrual version of accounting, it means that you recognize your revenues and expenses at the time that they are earned or they accrue. Whereas in a cash basis of accounting, you recognize revenues or expenses at the time they're either paid out or received. So I wanted to show you the difference between running a balance sheet with the cash basis selected and with the accrual basis selected. And you can do either one at any time. So if you run a cash basis balance sheet report, it does not show accounts receivable as an asset because it is not earned in a cash basis of accounting. Whereas if you run a balance sheet with the accrual basis selected, it includes accounts receivable. Hopefully this makes sense to you. Now on with our next transaction. And now we're ready for Transaction 3, recording clients paying off some of their credit balances. As you may recall from your T account exercises, on December 28, 20XX, a customer paid $500 toward their credit balance. On the next slide, we go over the first three steps of journalizing this transaction in our general journal. And now we discuss the first three steps in journalizing Transaction 3, recording partial payment of credit balances. First step, which accounts are affected? Cash and accounts receivable are the accounts affected. Step 2, what are the account types and do they increase or decrease? Cash is an asset type and it increases by $500. Accounts receivable is also an asset type. It decreases by $500. Step 3, which account is debited, which account is credited, and how much for each? Cash is debited for $500 and accounts receivable is credited for $500. On the next slide, we actually go through all the steps in journalizing this transaction. And now we're ready for Step 4, journalizing Transaction 3. you'll need your blank general journal form. Make sure you put page 2 at the top of the page where the page number is indicated. On line 1, you're going to put the year in the date column. On line 2, you're going to put the date of the transaction. On line 2, in the description column, you're going to enter cash flush with the left margin. Enter $500 in the debit column, including the 0 cents and leaving out the dollar sign. On the line directly underneath that one, you're going to enter accounts receivable, indented 1/2 inch from the left margin in the description column. Enter $500 in the credit column, including the 0 cents and leaving out the dollar sign. On the line directly underneath that one, you're going to enter a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. On the next slide, we begin our discussion of relating transaction 3 to a QuickBooks entry. Now we begin the process of relating transaction 3 to a QuickBooks entry. In QuickBooks, we enter a $500 check, number 2034, received from Sweetwater Mission, dated December 28th, which we apply towards their $1,500 balance on their invoice. We must use a received payments transaction to record this check. Because they have an outstanding invoice, we have to use the received payment function in QuickBooks. We can leave the balance as an underpayment or write off the extra amount. For now, we leave it as an underpayment because we believe we have an excellent chance of receiving the remaining $1,000. Again, I cannot stress to you enough the importance of using the received payment transaction when you receive any monies from an invoice that you issued. You cannot just treat it as a regular deposit. Now on the next slide, we continue our relating transaction 3 to QuickBooks by discussing the balance sheet that we run, including all transactions in our QuickBooks file to date. We continue our discussion of relating transaction 3 to QuickBooks. Since our income statement does not change, we did not run a separate income statement or profit and loss at this time. We just ran a balance sheet. Our balance sheet changed by showing the shift of the $500 from accounts receivable to cash. Otherwise, nothing else changes on our balance sheet. Hopefully this makes sense to you. Now we're ready for transaction 4. And now it's time for transaction 4. Owner takes a distribution of funds. As you may recall from your T account exercises on December 30th, 20XX, Sarah Jennings withdraws $1,000 from her business account. You may remember that Sarah keeps track of these withdrawals by using a drawing account which is closed out and amounts adjusted into the owner's equity account at the end of the year. Remember that increases in the drawing account are recorded as a debit, which is the opposite of the owner's equity account where increases are recorded as a credit. Before we move on to journalizing this transaction, have your general journal form ready as well as your handouts, and make sure you understand what you are doing before we move on to the next slide. And now we journalize transaction 4. Remember to leave a blank line in between transactions. In the date column, remember to put the date. Then enter Sarah Jennings drawing flush with the left margin in the description column. Enter $1,000 in the debit column, including the 0 cents and leaving out the comma and the dollar sign. Enter cash, indented 1/2 inch from the left margin in the description column directly below the first entry. Enter $1,000 in the credit column, including the 0 cents and leaving out the comma and the dollar sign. Right below that, you're going to enter a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. Be sure to double check your work and make sure you understand what you have just done before you proceed any further. On the next slide, we discuss relating transaction 4 to a QuickBooks entry. And now we relate transaction 4 to a QuickBooks entry. This is a simple write check transaction. In QuickBooks, Sarah Jennings is going to enter and print a check payable to the order of herself. Note that the cash account balance before we save the transaction displays above the check number. Once we save the transaction, the cash balance changes as reflected on the balance sheet at right, which shows our current cash total of $23,000. Note that our net income figure of $6,500 does not change, it stays the same. And in our equity section, you'll see the Sarah Jennings drawing account with a negative $1,000 balance. Our total current assets equal our total liabilities and equity of $25,500. Everything remains in balance. Now on to transaction 5. And now it's time for transaction 5. Bought professional insurance using a company credit card. As you may recall in your T account exercises, on December 30th, 20XX, Sarah Jennings took out a business liability insurance policy and paid a $300 annual premium using an American Express rewards card. The insurance policy is considered an asset of this business for the purposes of this exercise, as was in our T accounts, because remember, we are going to expense out this $300 annual premium over the course of a 12-month period. Now, before we go into actually journalizing this transaction, have your forms and handouts ready and make sure you understand the first 3 steps to journalizing this transaction before you move on to the next slide. And now it's time to journalize transaction 5. Before you do so, make sure you have all your forms that you need. If you see that you're not going to have room on page 2 to enter this transaction, go ahead and start a page 3 in accordance with the instructions on page 1 of your General Journal Part 1 handout. You're going to enter the date. You're going to enter prepaid insurance flush with the left margin in the description column on the same row. Enter $300 in the debit column, including the 0 cents and leaving out the dollar sign. On the next line, you're going to enter accounts payable Amex credit card, indented 1/2 inch from the left margin in the description column. Enter $300 in the credit column, including the 0 cents and leaving out the dollar sign. On the line right below that, you're going to enter a brief but detailed description of the transaction in the description column, indented 1 inch from the left margin. Make sure you double check your work and make sure you understand what you're doing before you proceed on to the next slide, where we relate transaction 5 to a QuickBooks entry. And now let's relate transaction 5 to a QuickBooks entry. Here is how the transaction appears in QuickBooks. It is recorded as a credit card transaction, as you can see below. In the memo section of this transaction, we write the following note: business liability insurance policy, 1-year term. It is important to make sure that you choose the correct account from your chart of accounts, because you may have 2 of the same account named insurance in your QuickBooks file. You can actually go in there and modify one of these if you want to, but we haven't done so in this exercise. So you need to make sure that you choose the insurance asset account instead of the insurance expense account. We will continue our discussion on the next slide of relating transaction 5 to QuickBooks by running an updated balance sheet. And now we continue relating transaction 5 to QuickBooks by showing you the updated balance sheet run after this last transaction was entered into our QuickBooks file. We did not run an updated income statement because it is unchanged, but the asset section of the balance sheet now shows a $300 line item for insurance, and we also show total liabilities now of $300 for the liability that we have on our Amex credit card. Total assets still equal total liabilities in owner's equity at $25,800. Everything remains in balance. Now we're ready for our last and final transaction, number 6. And now we're ready for our 6th and final transaction in this course, payment of rent for December. As you may recall in your T account exercises on December 30th, 20XX, Sarah Jennings wrote a check for $1,000 to pay for monthly rent for office space. Normally, rent is payable at the beginning of the month of occupancy, but for our example, the rent payment is due on the last day of the month. Again, make sure you have all your handouts and forms, and make sure you understand the first 3 steps of journalizing this transaction before we move on to step 4. And now we're going to journalize transaction 6, our final transaction in this course. Before you do so, make sure you have all your forms and handouts ready, so that way you can have everything at your disposal that you need. If you need to start a new page at this point, go ahead and do so. Wherever you start, make sure you first enter the date on the line that you're going to start recording the first line of your transaction with. On that same line, you're going to record rent expense flush with the left margin in the description column. Enter 1,000 in the debit column, including the 0 cents, and leaving out the comma and the dollar sign. Underneath that line, you're going to enter cash indented 1/2 inch from the left margin in the description column. Enter 1,000 in the credit column, including the 0 cents, and leaving out the comma and the dollar sign. Underneath that line, you're going to enter a brief but detailed description of the transaction in the description column indented 1 inch from the left margin. Before we move on to relating transaction 6 to a QuickBooks entry, which is on the next slide, make sure you double check your work and make sure you understand what you're doing before we proceed. And now we're relating transaction 6 to a QuickBooks entry. We simply use the write check feature, as you see below, to record the rent payment to Hillside Office Complex. I won't go into specific details on this check. Hopefully by now you know how it works. I will mention a couple of things here, however. Note the check number. Once you start putting in an initial check number, all your other check numbers will order in sequence, unless you want to change it. You can change it at any time. In fact, if you want to record a debit or an ACH payment, you would also use the write check feature to do that. You would just type ACH or debit where it says number. You can do that. It's very convenient to do that. Also, if you look at the expenses tab, you'll see that we have rent expense chosen as our account, which we have set up in our QuickBooks file. And in the memo, both in the check and in the line item below that in the expenses tab, we denote rent for December 20XX. And on our next slide, we begin our preparation of the fiscal year financial statements in QuickBooks. Congratulations for making it this far. We are now ready for preparation of our fiscal year end financial statements in QuickBooks. We have recorded the transactions for November and December operations in our QuickBooks file, and so now we are ready to run our final financial statements for our fiscal year end accounting cycle, starting with the income statement, or the profit and loss as known in QuickBooks. As you can see at right, the profit and loss statement shows our final net income figure for 2013 of $5,500, which consists of service income of $6,500 minus rent expense of $1,000. This statement will serve as our calendar year end statement as well as our fiscal year end statement. As such, the net income figure of $5,500 will be integrated with the fiscal year end balance sheet, which is shown on our next slide. We continue our preparation of fiscal year-end financial statements in QuickBooks with the creation of a balance sheet for year-end December 2013. Please note a separate statement of owner's equity is not needed when using QuickBooks because, as you can see, everything is integrated in this balance sheet here. Let's talk about where we stand at the year-end 2013. Our assets total $24,800. Our liabilities total $300 and consists of an Amex credit card charge. Our equity is adjusted to add the net income of $5,500 and to subtract the owner's draw of $1,000. Therefore, the accounting equation remains in balance as our assets total $24,800 which equals our liabilities of $300 plus our equity of $24,500. Everything is in balance. To compare with our manual system, on the next slide we include the balance sheet from our T accounts exercise. And also they're included in your handout for side-by-side comparison. We conclude our financial statements discussion by showing you a copy of the balance sheet created in our T accounts exercises. I want you to compare this with the balance sheet ran in QuickBooks on the previous slide. And on the last sheet of your handout in Part 2, you will see both of these on the same page, which you can compare easily and readily. With the exception of the QuickBooks Run balance sheet, breaking out some of the assets into subcategories, all the numbers match, which you will see if you look at each number line by line. Congratulations for making it this far. Hopefully now everything is making sense to you. I have one final thing I want to do, and I want to revisit the tasks in a typical accounting cycle on the next slide. Hopefully now that we've gone through all these exercises, these accounting cycle tasks will make sense to you. And now for our final slide, we are going to revisit the tasks in a typical accounting cycle. I will not read through these 8 steps again, but I will mention a couple of things that you probably would need to know, and this will hopefully solidify a lot of these steps and they'll make more sense to you. Particularly step 3. When posting journal entries into the individual ledger accounts, the individual ledger accounts, like I've said before, resemble the T accounts that we worked on earlier in this module. You will also, if you look at your sample general journal form and your blank general journal form, you'll see a column there that says post ref. That post ref column is very important. When you go to post the journal entries in the individual ledger accounts, you're going to write the page number where you post that information to. And in the individual ledger accounts, you're going to write the general journal reference also in that same column. So that way, when you see that those have references next to them, that means you've transferred that information into the manual ledger accounts. And that will help you when you're doing your trial balances to make sure everything remains in balance. That will be one of the things that you want to look at if your numbers do not balance after doing the trial balance in a manual system. Now, of course, everything is automated in QuickBooks, so you don't have to worry about that. But now that you've done these exercises and I've explained a little bit more about that process, hopefully you can appreciate these steps and they'll make more sense to you. Congratulations for completing Module 6 and for completing the Bookkeeping Basics course. I am honored and humbled that you chose me for your training needs, and if you need anything from me in the future, be sure to contact me and I'll be glad to help you any way that I can. Now for a couple Again, congratulations, and I look forward to helping you with any of your training needs in the future.